Think your crypto trades are anonymous? Think again. Governments know what crypto you buy, sell, and even hold. And they're coming for their share. Stay tuned because by the end of this video you'll know exactly how authorities track your transactions, and how you can stay compliant. Let's start with the biggest way governments track your crypto. Centralized exchanges like Binance, Coinbase, and Kraken. You see, to comply with anti-money laundering and know your customer regulations, these exchanges require you to hand over a huge amount of personal information. We're talking passports, driver's licenses, even selfies with you awkwardly holding a piece of paper. It's basically like handing the government a detailed map of your face and your finances. And once they have that information, well, it's not exactly a state secret that governments love to ask nicely, or not so nicely, for that data. Suddenly those Bitcoin you bought for, let's say, research purposes, aren't looking so anonymous anymore. But what if you're using decentralized wallets like MetaMask or Ledger? Aren't you safe? Well, here's the thing. The blockchain is a public ledger. Think of it like a giant permanent guest book that everyone can read. Every transaction you make, every little fraction of a Bitcoin you send, it's all recorded there for posterity, like a digital tattoo of your spending habits. And while your name might not be directly attached to your wallet address, with a little bit of detective work, governments and their fancy algorithms can connect the dots. Especially if you ever slip up and say use your credit card to buy a coffee with Bitcoin. Whoops! Governments don't always need the blockchain. They just follow the money. Think about it. To buy crypto, you usually need to use traditional money first. That means bank transfers, credit card purchases, or maybe you're one of those people who enjoys the thrill of a good old-fashioned wire transfer. No judgment here, just mild concern. But here's the kicker. Banks are legally obligated to report suspicious activity to the authorities. And you know what looks suspicious? Large sums of money suddenly flowing in and out of your account like a cryptocurrency tide. Many governments rely on self-reporting, but they're getting smarter. Yes, some governments still cling to the quaint notion that you'll voluntarily report your crypto gains, and to those people I say, bless your hearts. But don't get too comfortable because the taxman is getting a serious tech upgrade. We're talking about artificial intelligence, data analysis tools that make Sherlock Holmes look like a confused pigeon. These programs can sift through mountains of data, connect the digital dots, and basically build a crypto profile more detailed than your dating app bio. So what should you do to stay safe and avoid penalties? First off, don't panic. Knowledge is power. And now you're armed with more knowledge than a conspiracy theorist's internet search history. Second, keep meticulous records of your crypto transactions. And I mean meticulous. We're talking spreadsheets, timestamps, maybe even a handwritten diary entry for each trade, just to be safe. Finally, consult with a tax professional who specializes in cryptocurrency. Because let's face it, navigating the crypto tax landscape can be more confusing than trying to explain NFTs to your grandparents. Trust me, I've tried. Crypto isn't as anonymous as you think. But now you know how governments track it. The world of cryptocurrency is changing fast and governments are playing catch-up. But one thing's for sure, they're not giving up on getting their share. So stay informed, stay compliant, and most importantly, stay tuned. Do you think crypto should be taxed, or should it be totally private? Drop your thoughts in the comments below. Like, share and subscribe for more crypto legal insights. For expert legal advice, visit www.lawrence.com.